let's dig into this. We're doing a deep dive today that honestly could really shape your financial future. We're talking about how to actually get the most out of the US stock market. We've looked at a whole bunch of, well, pretty compelling sources, and they paint this really clear picture. On one hand, the market offers this huge long-term growth potential. It's pretty reliable historically speaking, but, and this is the big but, the data also shows why most everyday investors, miss out on a lot of that growth and kind of shoot themselves in the foot. So our mission today, it's to pull out the strategies that actually work. Strategies based on, real data, historical performance, and understanding investor behavior. The goal is to help you capture more of that market growth and maybe just as importantly, do it without all the emotional stress that leads to bad, short-sighted decisions.
Yeah, and I think we really need to start with the baseline. What does the market actually deliver over time?
Yeah.
Because I think, honestly, the biggest mistake people make is just not fully grasping how powerful and reliable that long-term trend has been.
Okay, so let's talk hard numbers then. What's the actual promise here historically?
Well, if you take the S&P 500, which is the standard benchmark for big U.S. companies, the long-term performance is, frankly, remarkable. Look back 10, 20, even 30 years or more. The average annual return, that we call the AGR, compound annual growth rate, it's consistently been around 10% or even a bit higher. That's the engine. That's the wealth creation machine we're talking about.
Okay, 10% a year, compounded, that sounds great. Sounds reliable. So here's the disconnect, right? If the market's giving 10%, why aren't most people seeing that in their own accounts? Where does it go wrong?
That is the million-dollar question, isn't it? It's what the industry calls the behavior gap. And it's not just one study saying this.
Yeah.
You look at the big names, Dilbar, Vanguard, Morningstar, they all show the same thing year after year. Investors consistently lag behind the returns of the actual funds or indexes they own.
So they pick the right horse, but they don't ride it properly.
That's a good way to put it, yeah. They have the right investment vehicle, the S&P 500 fund or whatever, but their actions, their behavior, keeps them from getting where that vehicle's going.
And this isn't just a tiny difference we're talking about. The analysis shows these mistakes, these behavioral errors, they drag down returns by, what, over 2% a year on average?
That's right, over 2% annually, averaged over decades.
Wow. 2% might not sound like a disaster in one year, but compound that shortfall over, say, 30 years of investing.
Oh, it's staggering. It's a huge amount of potential wealth just gone.
Yeah.
Vanished because of behavior.
And you mentioned the studies show it gets worse sometimes.
Yeah, what's really striking in the data is that, 2% is an average. When things get volatile, market crashes, sharp sell-offs, that gap can just explode. In those really emotional times, the analysis finds the difference between what the index did and what the average investor got can jump to over 5%, sometimes even 8%.
Okay, let's make that concrete. I remember seeing a specific recent example in the Dalbar data we looked at. Take a big growth year, like 2024. The S&P 500 returned over 25%. Fantastic year. But the average investor, they only captured about 16.5% of that. That's an 8.5% gap in 1 year, just left on the table because people presumably panicked or tried to time things wrong.
Exactly. That 8.5% is just a brutal number. It really highlights the cost of emotional trading. So if that's the effect, the underperformance, let's pivot to the causes. What specific actions are leading to this?
Right. What are those classic mistakes, the behaviors people need to watch out for in themselves?
Well, the list probably won't surprise you, but actually avoiding them is the hard part. It boils down to things like trading too much, just constantly churning the portfolio, chasing hot stocks, that fear of missing out, FOMO, or the flip side, selling everything out of fear when the market takes a dip.
Timing the market, basically. Trying to jump in and out.
Precisely. Entering or exiting at the worst possible moments. Or maybe just as bad, sitting in cash, totally paralyzed, waiting for that mythical perfect time to buy back in.
And I guess there are even riskier things people do that amplify the damage.
Oh, definitely. Things like putting way too much money into one or two speculative stocks, over-concentration, or using leverage borrowing money to invest. That just magnifies losses when things go south. And don't forget those super risky leveraged ETFs.
Right. So all these actions, they seem driven by, what, fear and greed. Is it that simple?
It often comes down to that, yes. Greed makes you chase rallies, buy high because you don't want to miss out. And fear makes you sell during downturns, right when things look bleakest, which locks in your losses.
Okay, but why? The math on losses is so clear, so punishing. Why do otherwise smart people seem to forget basic arithmetic when the market drops, say, 20%? We all know someone like that, right? sold everything in '08 or maybe March 2020, and they're still waiting on the sidelines for the perfect reentry point. Our research really hammered home how costly that waiting game is.
It's because the math of drawdowns is just brutal, and it feels counterintuitive in the moment. We really need to internalize this key point. Avoiding those big losses, or at least resisting the urge to panic sell during them, is absolutely crucial because losses require much bigger gains just to get back to even.
Right, the classic example, if your portfolio drops 50%.
You don't just need a 50% gain to recover, you need a 100% gain on what's left.
Double your money just to get back to where you started. Wow.
Exactly. And think about the long-term impact. Let's say you take a big hit, maybe 15 or 20% loss in a downturn. Okay, that happens. But then, if you let fear take over and you pull your money out, you sit in cash for, I don't know, a year, 2 years. The compounding engine just stops cold for you. The analysis we saw suggests that single mistake selling and staying out can cut your final wealth decades later by 50%, maybe even 80% or more.
Because the market eventually recovers, but if you're not in it.
Your portfolio doesn't recover. You miss the rebound. You miss the compounding. It's devastating.
Okay, this really drives home that maybe successful investing isn't so much about being a genius stock picker, but more about emotional discipline, control. So let's shift gears. Let's talk solutions. How do people move from being, emotionally reactive to being more disciplined, more rational? How do we use time as our ally?
Well, the core philosophy, really, it's about developing a kind of stoicism towards market volatility, accepting it as normal. And the strategies we pulled from the sources, they all point towards actively reducing those behavioral mistakes we just talked about.
Okay, and the sources seem to highlight about 5 key strategies for this long-term disciplined approach. Can you walk us through those?
Sure. First, really understand and internalize market history. Trust that long-term 10% average return. It's your anchor. Second, diversify. Diversify broadly. Don't let one bad stock blow up your entire plan. Index funds are great for this. Third, minimize trading. The less you tinker, generally the better off you are. Let compounding do its work. Fourth, avoid or at least drastically reduce chasing those hot, speculative stocks. Focus on the whole market. And fifth, maybe the hardest one, learn to embrace volatility. Understand that the potential for drops is actually why stocks offer higher returns than safer things like bonds. Risk and reward are linked.
That third point, minimizing trading, does that just mean buy and hold forever? Or does it also mean, like, not checking your portfolio balance 3 times a day?
It really means both. Frequent trading definitely tends to hurt returns. You've got transaction costs, potentially taxes, but mostly it just invites emotional decisions.
Yeah.
And yes, constantly checking, constantly reacting to the daily news or the ticker. That feeds the anxiety that leads to bad moves. True minimization means having a solid plan, automating your investments if possible, and then, trying to ignore the day-to-day noise.
Okay, that makes sense. And it reframes how we should think about market cycles, right? Like when the headlines are screaming recession, it feels scary. But if you're still saving, still accumulating wealth for the future.
It should actually be seen as an opportunity. Absolutely. Think about it. Lower prices mean every dollar you invest buys more shares of that index fund or those companies. You're essentially getting the market on sale. If you've got, say, 20 years until retirement, a recession is more like a financial gift than a crisis, assuming you keep investing.
And the sheer power of just staying invested, even through rough patches, was really highlighted by one specific data point we found. It was pretty stunning.
You mean the long-term rolling returns?
Yeah, the research looking back almost a century, right, to 1928. It showed that even the absolute worst 30-year period for the U.S. stock market, a period that included the Great Depression, World War II.
Unimaginable turmoil.
Right. Even that period still delivered something like an 8% average annual return.
8%. Think about that. Through the absolute worst economic disasters of modern history, if you just held on for 30 years, you still got significant positive returns. And every single other 30-year window since then performed even better, sometimes much better.
It's compelling evidence. The market might feel terrifying day to day sometimes, but history shows panic selling sitting on the sidelines. It's almost never the right long-term move.
It confirms that time in the market is far more important than trying to time the market.
Okay, so wrapping this up, what's the main message for you, the listener?
I think the key takeaway is pretty straightforward. Markets go up, markets go down. That's guaranteed. Fluctuations will happen. But ultimately, your behavior is what determines your financial outcome. Success really seems to boil down to patience, that emotional discipline we talked about, and keeping your eyes fixed on your long-term goals, not the short-term noise or, market sizzle.
Mm-hmm. Mastering your own impulses, that's your secret weapon here. If you can stick to a sensible plan, stay disciplined, avoid those classic traps chasing highs, selling lows, the market is incredibly reliable over the long run. It will deliver the kinds of returns that can secure your future.
All right, and as we finish this deep dive, we'd like to leave you with one final thought, something to chew on. Yeah, here's something to consider based on everything we've discussed. Most people tend to vastly overestimate what the market might do in the next year or two. That leads to impatience, maybe too much trading, disappointment. But at the same time, they wildly underestimate the incredible wealth that steady, disciplined investing and the power of compounding can generate over decades. So the thought is, invest like time is your single greatest asset, your ultimate ally. Because if you do, the market is likely to deliver life-changing returns far beyond what any short-term guess or gamble could ever realistically promise. Don't let those behavioral mistakes cost you, that 8.5% in a good year, or chip away 2% every year for your entire investing life. Stay the course.